Obviously, just super dramatic action in the banks right here. You have some with sort of existential questions around them, and others are just worried. I guess investors are just worried about their longer-term profitability. Are you seeing opportunities, or is it just time to stay out of the way?
Yeah, well, I mean, the market's still obviously pretty jittery. I think that goes without saying. I think the broad reality is that most banks will end up getting through this okay, but there are going to be some longer-term ramifications once the dust settles, and they'll be serious. So I don't want to minimize that. You know, it looks like the largest banks will probably come out of this looking the best, simply because the market has sort of concluded, hey, they're too big for the government to allow them to fail. They must be the safest places to custody money. So if anything, those types of largest banks will probably see inflows of deposits, ideally some customers that'll stick around once the dust settles. And at the much smaller end of the range, I think for the most part, it's business as usual. Their customers and management teams are sensitive to what's going on, but for the most part, they'll be impacted, but sort of only tangentially. It's really that sort of either 50 to 250 billion or 100 to 250 billion in asset bank that really looks like it'll get more squeezed in terms of kind of profitability longer term, and that'll take a few forms. It'll mean higher deposit costs as people really get serious about their funding and the value of it. I imagine those banks will probably kind of pare back their appetite to lend as well, just as they look to create capital. You'll probably see share repurchase start to get pulled back a little again as these companies build capital. There will be a heavier regulatory infrastructure as well, and then presumably whatever downturn we were going to have. Maybe gets a little harder if banks are more reticent to extend credit. So there will be some ramifications, but I think we'll be okay longer term.
If most are going to survive, as you say, which of course is the case by definition, there's been a lot of playbooks out there in terms of which ones to look for, whether percentage of uninsured deposits or just the diversity of the deposit base, maybe exposure to commercial real estate, things like that. Are there any rules of thumb you're following in terms of saying which stocks have been punished too much?
Yeah, you bet. I mean, JPMorgan is really always a good go-to in times of skittishness. Just excellent liquidity, excellent capital, excellent management, excellent overall risk profile. So they'll do, I think, extraordinarily well. If we look in the regional space, a couple of names we like include Citizens Financial here in the Northeast. Very good capital structure. They've got a really good kind of granular and diversified deposit base as well. So, good liquidity, and I think they've got a good risk profile. Similarly, if we're to go out to the Midwest, a name like Fifth Third down in Cincinnati, really good capital profile, good risk management, really well managed as well there. So those are a few names that we like.
And just quickly, the sell rating on B of A, what's that based on?
Oh, B of A, that's an excellent company. There's no question about that. Our underweight rating there has really been more of a function of perhaps, their NII outlook or their broadest revenue outlook, maybe being a little more aggressive vis-a-vis their closest peer, JPMorgan. But, it's an excellent company and will do well longer term. It's just that we prefer JPMorgan of the two.